This is question number 12 on the midterm exam. Compute and interpret liquidity, solvency, and coverage ratios. Selected balance sheet and income statement information for campaign corporation for 2004 and 2006 follows. We're provided with a bunch of numbers from both balance sheet and income statement, but obviously they are not complete. So part A, compute the following liquidity, solvency, and coverage ratios for both years. Round your answers to 2 decimal places. So you can see that this question is basically a question about calculating the different ratios. In order to do that, we just copy the numbers to, let's open a new Excel sheet here and paste text. So, and then we can first current ratio. Right? Current ratio is relatively straightforward to calculate. Because current ratio is defined to be current assets divided by current liabilities. So we just look for current assets and then divided by current liabilities. And then we just pull the cell to the other side, to the other year. So then we need to pay attention to the rounding requirement. Round your answers to 2 decimal places. And then we can just change the format cells to more cells because later on we're going to calculate more ratios. So just keep 2 decimal places. And this is 2004. And we just need to pay attention to order the order we input the answer, because the 2006 is on the right, but 2006 here is the first number we need to put. So we just copy the number on the right first to 2006, and then copy the number on the left to 2004. And that's what we need to pay attention to. And quick ratio. So quick ratio is defined to be, basically quick ratio eliminates the relatively illiquid current assets from the numerator of the current ratio and then keep the same denominator as the current liabilities. So basically we just include cash and cash equivalents and also include accounts receivable. And that's basically the numerator of the quick ratio. So we look for cash. Where's the cash? We have the cash here, and we have the accounts receivable. So we just take the sum of these two, cash and accounts receivable, and then we divide that by the current liabilities, and that's basically the quick ratio. And then we pull the cell to the other year. Again, we need to pay attention to the order because we need to put the 2006 number first, quick ratio, and then the 2004 number below it. And the next ratio is liabilities to equity. So liabilities to equity, let me use LTE. This is not 4G, right? 4G network. LTE is net liabilities to equity. So liabilities to equity, if we go to chapter 4 on the risk, credit risk analysis, that module, liabilities to equity is defined to be total liabilities divided by stockholders' equity, right? So it's total liabilities. Where is the total liabilities? And it's right here. And then we divide that by the shareholders' equity. Where is shareholders' equity? Is that provided? Actually, no, it's not directly provided, but does that mean the question cannot be solved? No, because we know that when we know the current, oh, actually it is, yeah, it is, it's equity right here. I just missed it. So it's the equity there, and then that's the total liabilities to equity. So pay attention to the other here. Actually, it turns out to be a negative number. And the reason for that is because the equity here is a negative number. So again, we just copy the number back, but pay attention to the order, 2006 first, and then negative sign there because it's a negative number, and then 2004 below it. And then total debt to equity. Total debt to equity, okay? Or maybe just use the debt to equity, DTE. So this is defined to be the equity, the denominator is the same as the liabilities to equity, but the numerator will change to be the current, if you go back to the next slides, it's the long-term debt, including the current portion, plus short-term debt. So then we just look for, it's basically short-term debt and long-term debt, right? This long-term debt here, the short-term debt here includes the current portion of the long-term debt. And that's basically what this means, the current portion of the long-term debt, and then this short-term debt. So we just take the sum, calculate the sum of these two numbers, long-term debt and short-term debt, and then we divide that by the same denominator as the liabilities to equity, which is equity here. So then we pull the cell to the other year. Again, the reason why it's negative is because of the negative equity there. So just copy the number back and then add a minus sign there. And this for 2004. And then times interest earned. So TIE. This is basically the earnings before tax plus interest, right? If we go back to the lecture slides, this is earnings before tax. This is one of the coverage ratios, by the way. So, and this times interest earned is earnings before tax plus interest expense and divided by interest expense. So go back to the formula. So this is the EBT, earnings before tax, earnings before interest and taxes. And then there's no earnings before tax, but as we know, earnings before interest and tax minus the interest is basically earnings before tax. So earnings before tax add up the interest. Basically goes back to the earnings before interest and tax. So we just use the number here. And then divide that by the interest expense. So interest expense is right here. And then pull the cell. Again, the order matters. 2006 first and 2004. We know that. So that's the times interest earned. And cash from operations to total debt. So this is defined to be cash from operations right here. Cash from operations total debt is the cash from operations divided by short-term debt plus long-term debt. So the denominator is the same as the numerator of the total debt to equity ratio, right? And then the numerator here is the cash from operations. That's basically from the cash flow statement. So then go back to the Excel sheet. So this is the cash from operations, CFO, cash from operations to debt, So this is basically the cash from operations, the numerator, and then the denominator is the sum of the long-term debt and the short-term debt. Okay, so it turns out why this is a zero number. That's because it's very small, It's a very small number, so it turns out to be 0, but it's actually not 0 because the cash from operations here is positive. So this is a very small positive number. That's why it's shown as a. But when we keep two decimal places following the rounding requirement, it turns out to be 0.0. Okay, 0.00. And then for the other year, sorry, that's why I kept saying we need to be careful because that's actually the number for 2004, not for 2006. So we need to, and then for 2006, it turns out to be 0.04. And 2006 free operating cash flow to total debt. Okay, so free operating cash flow to total debt. And so this turns out to be, we just manipulate the numerator of the cash flow from operations to total debt by subtracting the capital expenditure from the cash from operations. So we just take the difference between the cash from operations and then the capital expenditure, and then we divide it by the same denominator, which is the we need to add parentheses because we need to add up the long-term debt and the short-term debt. So that's basically the free cash flow from operations, free cash flow from operations for to total debt. I guess this should be going back to the free operating cash flow, free cash flow from operations, or free operating cash flow to total debt. Okay, so we just copy back and copy back again, add a sign, minus sign there. It's a negative number. So which of the following best describes the company's credit risk? And then we just look for all these four choices about quick ratios and current ratio. So then we can just go back and check whether we have some idea about the time pattern of these two ratios. So current ratio 2006 is lower than the current ratio of 2004, and that's the same for quick ratio. And current ratio for 2006 is below 1, right? So it's we just try to see whether any of the choices here matches that observation. Both the quick ratio and the current ratio for 2006 are lower than 1, and that's not that's actually the case. Yes, both are lower than 1, and by that actually we can rule out the last of two choices, right? Only the first two choices are saying that these two ratios are lower than 1 for 2006 and have decreased in the past 2 years. So this second one is have increased in the past 2 years. Simply by this statement, we can rule out the second one because we have observed that these two ratios have decreased over the past 2 years, right? And we further look at along with interest coverage ratios that are exceedingly low. And then what's the interest coverage ratios? So that's basically the same as the times interest earned, right? That's another name for the interest coverage ratio. And in this case, it's a bit low. It's a bit low, even though it's higher than 1, but it is a bit low because the generally this should be greater than 2, but it turns out to be smaller than 2. Speaking of the probability that the company will face default has significantly increased. That seems to be the case. Yeah, so we choose this choice.